You know, in finance, we always hear about that golden rule. To get a higher return, you've got to take on more risk. It makes sense, right? But what if I told you that a huge chunk of the risk you might be taking on is completely, 100% unrewarded? That's the mind-bending idea we're going to unpack today.
So let's just kick things off with this big question. What if some of the risk baked into your investments is earning you absolutely nothing, not a single cent in extra reward? It sounds kind of crazy, but wrapping your head around this is the key to understanding how modern finance puts a price on, well, pretty much everything.
You see, it turns out there are two fundamentally different types of risk out there. And here's the wild part. The market only pays you for taking on one of them. The other kind of risk, it's just completely ignored.
In this slide, it gives us the perfect way to think about this. On the left, picture a single ship in a huge fleet. Its engine fails. Now, that's a total disaster for that one ship, right? But the rest of the fleet just sails on. That's what we call non-systematic risk. But on the right, imagine a massive hurricane that hits the entire fleet. There's just no escaping it. That is systematic risk. One is specific, you can isolate it. The other one affects everybody.
And this, right here, is the absolute key. The market doesn't pay you a premium for taking on that single failing engine risk. And why would it? You can get rid of that risk for free just by owning more ships, or in our case, more stocks. The only risk you actually get rewarded for is the one nobody can escape, that big, systematic, hurricane-level risk.
So you're probably wondering, how does this so-called magic of diversification actually work? How do you just make that uncompensated risk disappear? Let's take a look.
This timeline really lays it all out. If you own just one stock, you're exposed to all of its unique, specific problems. But as you start adding more and more stocks, their individual good news and bad news, that non-systematic risk, it all starts to cancel each other out. And look what happens. By the time you get to around 30 different stocks, you've pretty much wiped out all of that company's specific noise. All you're left with is the pure market risk you're actually getting paid to take on. Okay, so what does this all lead to? Well, it leads to a really powerful idea. If every smart investor out there is trying to ditch that unrewarded risk, then in theory, they should all end up holding the same perfectly diversified portfolio. From that point on, their only decision is how to mix that risky portfolio with something totally safe. And this optimal path has a name. It's called the Capital Market Line, or CML. Seriously, think of it like the ultimate master recipe for investing. It shows you the absolute best possible trade-off between risk and return you can get, just by blending a totally risk-free asset, like a government T-bill, with the whole market. Okay, so let's put this into practice. Let's say we have an investor, we'll call him Mr. Miles. He's a bit conservative, so he puts most of his money into those super safe T-bills and just a small slice into the market. By doing this, he's basically lending his money at a guaranteed rate. This mix gives him a nice, modest return for taking on very little risk, and it puts him right on the low end of that capital market line. Now, if he wants the average market return, it's simple. He just puts 100% of his money into that market portfolio. He's not lending, he's not borrowing, he's just taking on the standard amount of market risk for the standard market return. But what if Mr. Miles is feeling a little more ambitious? What if he wants an even higher return? Well, he can actually move up the CML by borrowing money at that low risk-free rate and then investing all of it, his money plus the borrowed money, into the market. This is what we call leverage, and it's a powerful tool. It magnifies his potential gains, but, and this is so important, it also magnifies his potential losses. All right, so we figured out that the only risk that really matters for your return is that big picture systematic market risk. The big question now is, how on earth do we measure it for just one specific stock or asset? Well, we do it with this one, super elegant number. It's called beta. Beta tells you, with a single number, exactly how sensitive an asset is to the movements of the overall market. It is the measurement of systematic risk. And figuring out what beta means, it's actually pretty simple. If a stock has a beta of exactly 1.0, it moves right in line with the market. If its beta is greater than 1, it's more volatile. It's going to jump higher when the market goes up and fall harder when it goes down. A beta of 0 means it doesn't care what the market does at all. And a negative beta, which is pretty rare, means it actually tends to go up when the market goes down. Okay, let's take a breath. We've got the risk that matters.
systematic risk. We've got the tool to measure it, beta. So now we're at the grand finale, the model that ties this all together to figure out the fair price or the expected return for taking on that risk. And here it is, the famous capital asset pricing model, or CAP for short. Now look, don't let the formula scare you off. Seriously, the idea behind it is what's so powerful, and it's actually incredibly intuitive. Let's just walk through it step by step. To find the return you should expect from any asset, you start with the baseline, the return you can get for zero risk. That's the risk-free rate. Then you add the extra bonus the market gives you just for taking on average market risk. We call that the market risk premium. And finally, this is the magic part, you dial that bonus up or down using the asset's specific beta. If it has a high beta, it gets a bigger bonus. A low beta, a smaller bonus. Simple as that. And you know what's cool? When you draw this relationship on a graph, you get what's called the security market line, or SML. I want you to think of this as the ultimate fair price tag for risk in the entire market. For any amount of systematic risk you take on, the SML tells you exactly what kind of return you should be demanding. And believe me, this isn't just some abstract theory for a textbook. This model has incredibly powerful uses in the real world. That SML line becomes our benchmark for judging literally any investment. It's actually pretty simple. If an analyst thinks a stock's return is going to land above that SML line, it means that stock is offering more reward than it should for its level of risk. That's a potential bargain. It might be undervalued. On the flip side, if a stock's expected return plots below the line, it's not offering enough bang for your buck. It might be overvalued. We can even use this whole framework to see which professional investors are actually good at their jobs. A lot of people use something called the Sharpe ratio, but look, it judges a manager based on their return versus total risk, which includes all that unrewarded risk we talked about. But a smarter metric, like Jensen's alpha, is different. It measures a manager's performance after accounting for the systematic risk they took. It tells us if they actually generated extra return through skill, or if they just got paid for taking on the right kind of risk. So if there's just one thing you remember from all of this, let it be this. In the world of investing, the risk that truly matters, the risk that you get paid for, isn't the unique risk that a single company might fail. It's the big picture risk that you share with everyone else in the market. So that's what I want to leave you with. Now that you can actually see how the market puts a precise price on risk, and just as importantly, which risk it completely ignores, how is that going to change the way you look at your own investments?